My name's Alec McCutcheon. I'm a Director of Unicom. We're very pleased to be hosting today's webinar, which is on the subject of the sentimental market hypotheses, how crowd emotion drives market prices. And the presenter today is Dr. Richard Peterson, who's CEO of Market Psych Data. It's an organization which produces psychological and macroeconomic data derived from text analytics of news and social media, and this is used by some of the world's largest hedge funds. Just to mention also that Richard will be coming to the UK in June to present at the conference which is taking place, the 4th Annual Conference of Behavioural Models and Sentiment Analysis Applied to Finance. That's on 18th and 19th of June in London. There's details available at unicom.co.uk. Just to mention before I hand over to Richard, there will be opportunity for questions at the end, so please feel free to type questions and Richard will endeavour to answer as many of them as possible as they come up. We are scheduled to finish at 3:45, but it's a lot of questions. We may go on a few minutes after that. Also, just to mention that we will be making the webinar recording available online afterwards, and we'll be sending out a link. So without further ado, I'll hand over to Richard.
Thank you. So thanks for hosting this webinar today. It's been our pleasure and really my life's work investigating how emotion and sentiment drive market prices and, of course, individual behavior as well, because the market is made up of individual investors, and how investors as a group or as a herd drive prices in their buying and selling behavior is what we're going to talk about today. So there's been a lot of history around this particular topic, trying to understand what is the cycle of a bubble. When does a bubble turn into discord, as you can see in this slide, and then ultimately, how does panic evolve out of that process? Now, there are many famous quotes about trying to invest into a bubble and how to time the top, such as John Maynard Keynes, who said, the markets will remain irrational longer than you and I can remain silent. So it's not that you want to jump into a bubble and short it because you know it's a bubble. You've actually got to have a much more nuanced understanding of how investor psychology drives prices. And while this cycle that you see in the slide is anecdotal, there's really an issue here, which is can we study this scientifically and rationally? So in this next slide, we're looking at a saying that's been made since Rothschild here: buy to the sound of cannons, sell to the sound of trumpets. Now, the more modern incarnation is something Warren Buffett has said, we buy when others are fearful, we sell when others are greedy. Or his mentor Ben Graham said, we buy from pessimists, we sell to optimists. It's all along the same lines that the best time to buy into a market is when there is war or negativity or fear. The question is, it's much obviously it's much easier said than done, and the question is, does it really work? Here's one high-impact example that I have on the slide, which is Pakistan, which is over the last 3 years one of the top-performing stock markets in the world. And the question is, again, was it a good idea to buy into Pakistan during unrest in that country? Is it a good idea to buy into a company when there's management change or fraud in the company? Is it a good idea to buy when there's extremely negative news, fundamentally? And so what we'll do today is talk about some of the scientific information that we've been gathering and look at data gathered from news and social media that confirms some aspects of that thesis, but not all. So we know from behavioral economics that individuals make irrational decisions, predictably irrational decisions, in conditions of stress or uncertainty or given certain frames in their decision or reference points. Advertisers use this to manipulate buying and selling behavior, as is their job. In the financial markets, unscrupulous actors also use it. You've ever received a fax, a spam fax about a Calgary gold mining company that's going to double in the next 2 weeks? Well, that's one of those commentaries. If you look at the commentary and deconstruct it, see these psychological elements that are predictive of risk-taking in individuals. So what they're doing in that fax is they're using bold print and lots of exclamation points, and they are using a tone of certainty, and they're telling you that there will be large rewards coming from your investment. They're also telling you that this is something to be excited about, and that if you get in now as one of the privileged few, you will have the opportunity to double your money. So they know how to manipulate people's risk-taking behavior to get you into this pump and dump scheme, which is their penny stock. But the question is, does this effect filter throughout markets? Can we see it elsewhere? And are there other factors at play, such as we find in behavioral economics, where there are over 50 identified biases that individuals are susceptible to? Now, we know, of course, anecdotally again, that sentiment is associated with bubbles, with panics, that there are market regimes that can be defined by the psychology of news flow and social media. So then the question again is, but how do we predict this? How do we know if we're really in a bubble? I mean, we've got Robert Shiller's PE ratio. We've got other people looking at open interest or fund flow information. All of this is valuable. What we're doing specifically at MarketPsych is we've started looking at social media and news media. I shouldn't say we've started because we've been doing it since 2004. So for the last 10 years, we've been doing textual analytics of news and social media to understand what are the emotional states, what are the macroeconomic themes that are associated with bubble tops and bottoms, and how can we time our entry and exit to have superior returns over time. We developed the Thomson Reuters MarketPsych indices to answer this question of how do we understand the psychology of markets. So we've been doing the text analytics, as I said, since 2004. We also do a number of other activities in our business. We do coaching and training. We have portfolio managers and financial advisors. We've also done quite a bit of academic work, publishing pretty widely in academic journals and textbooks. And much of what we're doing is based on the work of pioneers such as Dan Kahneman. His work and others in his school of thinking called behavioral economics have identified that how investors and how decision makers make their choices depends on weights. That is, we weight some things more than others. Now, in the traditional economic theory, we're all rational, and we weight everything according to its expected value. And in the case of uncertainty, then we use our best possible information about histories, etc. What Daniel Kahneman and his colleagues have found in this behavioral economics field is that decision weights are actually strongly influenced by factors such as fluency or vividness, that is, the ease of calling something to mind, or the ease of recall or storing it in our mind, the cognitive centers of the brain. Also, availability, which is how recently have we seen it? Is it easily recalled from memory? So these are sort of cognitive details. We're not talking about sentiment. We're just talking about essentially characteristics of information that cause it to be overweighted in how we make a judgment. And interestingly, there's evidence that these overweightings do affect stock prices. So in a famous paper called All That Glitters is Gold, Terry O'Dean at UC Berkeley identified that news flow tends to predict stock buying and selling behavior among individual and institutional investors. In fact, when positive news comes out of a company, there is a tenfold increase in the baseline rate of buying of shares in that company using data from a large individual brokerage set that he's got. Then, interestingly, when negative news comes out about a company, the baseline rate of buying increases by twofold, so it doubles versus tenfold when it's positive news. Nonetheless, simply having that awareness of a company increases the baseline buying behavior. The only group in his sample that did not buy on negative news was institutional value investors. Those were the people who did not buy when negative news came out, interestingly. I'm finding that's fairly important is that stocks with pronounceable symbols, that is with consonants bordering a vowel in a way that's similar to something in the English language, those stocks are found to outperform stocks without pronounceable symbols over time. And stocks with symbols that have meanings, such as love for Southwest Airlines or advanced medical optics with I, those stocks actually outperform substantially. I think it was more than 1,000 basis points annually in a portfolio that they created of what they called pronounceable stock symbols. And there were a number of theories behind this. Perhaps they had more innovative marketing teams, or they were more innovative generally, that they came up with these ideas. But in fact, given that pronounceable symbols also outperform, it's probably something to do with the ease of recall. When you go and sit down at your computer, you like Southwest Airlines because of its cute ticker of love, and it's something that's more easily recalled as well. So the underlying theory may be that people simply do what's available to them. This is all around attention. That is, our attention is captured by things that are fluent, that are vivid, that are available to us, to our mind, whether it's via recent effects or memory. So these cognitive effects matter. Now, we'll talk about sentiment as well, emotional priming. So this talk today will focus on attention, how we allocate our attention, and how we see in our news data that attention is driven across asset classes by different themes. Then we'll talk about sentiments that are expressed by investors, and how those are predictive of prices at different times. And then also specifically we'll look at overall volume of buzz and chatter, and how that seems to affect prices over time. And when I say over time, the studies that I'll be citing today are 12-month out studies, so looking at 12-month forecast periods. So in this study, subjects in the study were asked to choose. They're asked to make a choice between guaranteed money or taking a gamble. The guaranteed money was $10. The gamble that they could choose was the flip of a coin. If the coin landed on heads, they would win $30. If it landed on tails, they'd win $0. So the expected values of economics would all take the guarantee or the gamble. But in fact, half the people take the gamble. And this includes a pool of Stanford graduate students who took this test as well. Half of them take the guaranteed, half of them. A number of ways to manipulate how people choose gamble and to label that face as a man or a woman. And then to answer this face, they were 30% less likely to take the gamble than if there was a happy expression on the face. Now, most said, that face didn't affect me. Why would it? How could it? It's just some face. Before and after the choice, they had the same rating. On average, nobody changed in how they felt. So the effect of this face's emotional expression was not conscious. A 30% deviation that was completely unaware to the subjects in the experiment. This is called emotional priming. It occurs unconsciously, and it also occurs beyond faces in headlines like "Analysts see Dow hitting 5,000." That was the Wall Street Journal headline near the bottom in March 2009. There's also headlines like Greece or Eurozone fracturing with riots in Greece, such as occurred before the flash crash in May 2010. These people, we're not aware of it as investors, but it does change how we predict effect, as you can see here. And some of the last data that I want to show you, though, to bolster the case that I'll be presenting, is that affect-rich or emotionally loaded information is overweighted in how we assess probabilities. So it's not only fluency and availability, but also emotion that alters how we judge probabilities. So a low probability event, a 1% chance of dying from surgery, is very terrifying to people, to the extent that many people will not engage in that activity, or a 1% chance of cancer from living near a nuclear site. No one wants to live near a nuclear site if they can choose otherwise, given that probability. It's the emotionally weighted probability is very terrifying. Now, when you're considering your assets and your money, and the idea that, well, if I invest in Pakistan, I have a 10% chance I'll lose all my money because the government will implode and the financial system will collapse, it'd be much higher. So what I'm getting at here is that there are emotionally salient or impactful events that are causing people to take inappropriate amounts of risk, either too little risk or too much risk. This is Hurricane Katrina. Great investors have long known what I'm saying. And when you look at the insurance industry, you see that the best and the savviest investors tend to go and buy insurance companies like Wilbur Ross or Warren Buffett did after Hurricane Katrina. They go into those areas that have been the most damaged, and then they buy insurance companies. Why? Because they can charge a higher premium on the insurance policies, and because the statistical odds of the hurricane are no different after the hurricane, but the event in people's minds is low. So as a result, buying insurance is actually a mistake to do so after a big event like this that reminds us how much we need insurance. So again, we have the psychological cycle. How does this play into what we tend to see in markets? And what this cycle shows here is the NASDAQ through the tech bubble of 2000, the peak being March of 2000. So let's look at some data. We have this comprehensive time series of sentiment data based on news and social media that's out there. So we have crunched a number of sources back to the 1980s even, including the Wall Street Journal, the New York Times, Financial Times, etc. We also have social media content in a separate feed from our news feed, including Twitter content as well as message board content and blogs, even comment streams from major websites. like business news. So we're able to see how people are thinking and commenting about the stock market and specific assets in real time. We break all this down into numbers. So we have fear from the news, fear from social media, for example, for Microsoft in Minute. It's a minutely used feed. So we track lots of, and of course, content has evolved over time, 2010, and then it continues to grow. So there's a lot of different types of content over time. Opinionated first person to be more objective and tends to have a third-party news to make sure that it's all has more than 7,000 external. It's not spam news, and it's actually breaking the news around the world. And countries, equities, currencies, it's those that I care to go through in a slide, but. And we cover a number of assets, so 130 countries, naphtha, orange juice, 7,000 global equities are different assets, looking at how people, these massive streaming files, basically digits. So they have their own computers and algorithms that process. Our in part is to help everyone working in terms of algorithmic trading around us, which provides lessons for us. Slide here. And I won't go through everything, how sentiment impacts investing. So I cite a number of the key papers here. It impacts relative value. So just like Buffett and Graham have said, you do want to buy when others are fearful or pessimistic. The question is exactly how do you time that and some other factors that I'll guess. We also see that there is information about fundamental shocks. So earnings at a company, earnings are existential to a company. And when there's a disruption in earnings, that's important. For commodities, surpluses or oversupply is key. So is also shortages. So these are important as well to market participants. And we see fundamental shocks as being important. And then we also find that on a fundamental level, we can actually, by quantifying the news flow, we can actually predict economic activity by how people are feeling one day tends to seem to predict economic activity the following day to month. And I'll show you a model of that quickly. Then, of course, sentiment tends to augment technical strategies, which is, you'll see a couple examples throughout this presentation. And then there are classic behavioral strategies, such as buying into overreaction. That is largely what I'm talking about today, is that fear and anger create mispricings. That is, people don't take risk when they should, and they undervalue opportunities that exist because they're, for example, too afraid, paralyzed by fear. And that creates opportunities around overreaction and panic. Then there's also a lot of work in this area around volatility forecasting. We're seeing some interesting results there in our data, and consensus around events, meaning crucially, how are people positioned before an event like Apple's earnings or the release of the iPhone? We saw before the release of the latest iPhone 5C and 5S was there was a huge amount of positive expectation built into the market. The product was demonstrated, the market fell, or I should say, our share price fell dramatically. And then later, as the sales started rolling in, a week later, it started recovering dramatically as well. But it was that unveiling into such a high period of expectations that expectations had nothing to do but be disappointed by what it was. So we have a number of evidence that we've obtained through quantitative studies. So I'll describe how the studies I'm going to show you were developed so that you can understand really the mechanism and the justification for me to make the assertions that sentiment does matter in markets. So what we did was we looked at the last 12 months of sentiment for any given asset. We then often, in every of these cases, we ranked the assets by the volume of conversation about them. And we took top tier, the ones with the most conversation. And then we would look at the next 12-month period. If we ranked, for example, we took the top 20 countries in the news and then ranked them by joy. That's just a very brief example you see on this slide. We ranked the top 20 countries in the news by their level of joy. And then we arbitraged the top 4 versus the bottom 4. What would our equity curve look like? That is, at the end of 1 year, rank them by the average value of joy for that 1 year. Then take the top 4 highest ranked joy and buy those. And take the bottom 4 lowest ranked joy and short those. Then hold that for 12 months and then renew the process again and hold it again for 12 months. Now, to be more of an appropriate quantitative study, we actually updated it every 1 month with 1/12 of the portfolio to make sure that we had as much coverage as possible. So this is actually a rolling 1-month window holding it for 12 months, so annual holding period. And what you find are interesting results like this, which is this one shows that, in fact, you want to short the happy countries and buy the miserable countries. And that if you do so, over the last 14 years, you would have made more than a fourfold return on your money. So there's something interesting in this data, and I'll show you more evidence of this. First, we'll start with U.S. equities. And I'll start with just showing you a visual. This is an example of an index we created called the Market Risk Index. The Market Risk Index is based on a composite of words and phrases and expressions that people use when they're speculating versus those they use when they've given up hope. So, for example, day traders or gunslingers in the 1960s or house flippers in 2006, they had a certain vernacular, like, I'm going to buy it and I'm going to flip it for a higher price. They're not talking about the fundamentals, like how much money they're going to earn from the property or their income. What they really tended to think about was, how can I buy it now at a low price and sell it later at a high price, and usually not very long later. They also tended to make expressions with positive expectations, optimism, and they also tended to have not only optimism but positive emotionality. So a lot of joy, phrases like, I love it, I like it, it's doing great. So we calculated, we quantified the positive emotionality, the positive expectations, and references to the price, and then we subtracted out analytical, fundamental-based references, as well as pessimism and negative emotionality. What we get is a fairly interesting model of the business cycle, at least in the stock market. So over periods of time, when you have a short-term average versus a longer-term average, you find that there are some interesting opportunities here. And we actually ran some machine learning on this to identify what the ideal averages would be. And in fact, this looks like it's not the correct slide here. You can see earnings expectations for the S&P, fundamental strength, and fear are some of the most important drivers in terms of the S&P 500. But this was a machine fit, so I wouldn't say that it's something you want to trade on, obviously. What I will say is important is some of this information. So we find that when you take the Russell 1000 stocks, so the top 1,000 stocks in the United States, you arbitrage the top 100 versus the bottom 100 on any one of these indexes, then you get interesting results. And keep in mind, on the buzz, some of these have a negative sign preceding them. So what you see with the buzz here is you'd want to actually short the top 100 most talked about stocks in the U.S. and buy the 100 least talked about stocks in the U.S. out of the top 1,000. So this is a decile arbitrage. And, you know, it's not perfect, but over time you have what's called an absolute return from this arbitrage. That is, it's almost like the small cap outperformance, that stocks that are little discussed or where there's little attention paid actually tend to outperform those where there's a lot of attention paid. So the stocks that people are talking about tend to underperform, while the ones that they're not talking about tend to outperform. Sort of goes along the lines of undiscovered gems. Now, that was with the top 100 and bottom 100 of the first example here. This one is the top 20 and bottom 20. So this is a sensitivity analysis, attempting to look much more detail. Does this effect accelerate at the extremes? And you can see a twofold return approximately using the deciles. When you go out even further to the top and bottom 20, you see not quite, but almost a fourfold return over that period. This is what we call the attention effect. Then we have high impact topics. So when you think about behavioral economics, people talk about attention and fluency, for example. They also talk about vividness. The topics that are vivid to people are things, especially in equities, are things like innovation. Is this company innovative? And another one that's vivid to investors is, what's the market forecast? Where do people think this is going? Obviously, most of us are investing because we want something to go up. So what we see with these is similarly interesting equity curves here. Now keep in mind, these blue lines are equity curves. That is, $1 invested in the top, say 50 cents invested buying the top decile and 50 cents invested shorting the bottom decile. Over time, how much money would you have at the end of a long period of rotating every year, etc., and doing this type of rotation? what you see is that, in fact, you do eke out a little bit of what's called an absolute return. That is a return independent of what the market's doing. So with the market forecast variable here, we see that highly forecasted stocks, that is stocks that are generally forecasted to rise, especially starting in 2007, outperformed stocks that were forecasted to fall. So there was some wisdom of the crowds here, or maybe a momentum effect, in that people jumped into those stocks that seem to be, or that are rumored to be outperforming. At the same time, innovative companies also seem to have some outperformance. That is, companies that are considered largely innovative by the group tend to be outperformers versus low innovation companies, especially perhaps accelerated by the banks, which are rarely thought of as innovative in the 2008 crisis. And then purely on an emotional level, so references to fear or anger about a company. So this is when a CEO or an executive would say something like, I'm worried about my Apple position. I'm sorry, not the CEO or the executive, but the investing public in Twitter or on a message board might say, I'm feeling a little cautious about Apple right now, or I'm a little concerned about Cisco. That would come out as fear. And fear is interesting, kind of messy at some points. I'm not sure I'd want to put any capital into the fear itself. But interestingly, anger is much more consistent and has a much higher Sharpe ratio. And so one of our lessons from this data has been that, especially among stocks, it's smarter to buy anger than it is to buy fear. You more likely want to buy when others are angry than when others are fearful. And there's actually some interesting neuroscience evidence about how anger causes people to be more certain and fixed in their beliefs that something is essentially bad or wrong. And as a result of that certainty and being fixated on that fact, people tend not to take advantage of the opportunity it creates. Whereas in fear, they're usually waiting for some feared event, and when that event clears away, people tend to reset their expectations back to normal. Anger is more of a chronic effect. That's why we have expressions like hold a grudge, because people hold anger and its cognitive effects for longer, to their own detriment in the financial markets. Now, when you combine a number of these factors like fear, joy, and anger, innovation, you actually find that you can create interesting investment strategies. And when I say interesting, I mean these have been modeled by our Chief of Analytics, C.J. Liu, who's really phenomenal with this work. And he's found that we can create interesting equity curves over time. This one was actually launched when it was put on our website when this blue window occurred. And since it was put on our website, I snapshotted this yesterday. It has outperformed beyond expectations, so we are expecting it to slow down a bit. But it's certainly been quite interesting. This is an annual holding period, and again, it's taking advantage of some of the emotions that are out there. So you see some expected ones here, like Carnival Cruise Lines, with their overflowing toilets and killing their own staff accidentally, things like that. Carnival Cruise has taken a really bad rap, and as a result, it actually came out as being a buy signal in our measures here. And Exxon gets a lot of heat. Of course, Netflix, everyone loves to hate Netflix. So there's some interesting buy signals here. And of course, Netflix has been on here a while and have been doing quite well. By the way, this is available on our website. Internally actually it's, I apologize. It's available to our institutional and researcher users. So if you have interest in this level of analysis, please let us know. So on the global level, we do find that our indexes are also predictive of global equities. Now here's an example from our website of our global maps. This is social unrest in Ukraine and Thailand. We have a couple software developers in Ukraine, and one day one of them said, there's people streaming down outside my window down to Maidan Square. And we said, oh, it must be a protest. Let's see if we're picking it up. And sure enough, we had Ukraine was flashing red for the social unrest. So the question is, like Rothschild said, do we want to buy to the sound of cannons? So is Ukraine a buy? Not that that's on everyone's mind, but it certainly is on Ukrainians' mind and many global investors. And it really teaches us some lessons about what does matter in the markets. So what we see here is that on the attention level, that what people pay attention to, and again, this is the example of taking the top 20 countries in the news, going long the top 4 versus shorting the bottom 4 of those top 20 countries and holding for 12 months. And again, this is updated monthly with 1/12 of the portfolio starting in 1999. What we see is not a really clear relationship. So while there's initial outperformance, Buzz didn't really do much for us recently. So hard to say that there's any intrinsic value here in the Buzz. Where people pay attention globally may not matter that much. However, what does matter is what they're paying attention to. Natural disasters is actually a really good buy signal. So again, this meets that criteria of vividness and fluency. When we hear about a tsunami, when we hear about a massive earthquake, these things matter to us. And they tend to, in our evidence, they probably are steering sovereign wealth funds and major pension funds away from a region while it's down on its knees and having been damaged. In fact, that's actually the best time to put your capital to work there, according to this. Probably because of increased government spending or whatever, but that country's stock index is likely to outperform. So again, when I say we're shorting 4 countries versus buying 4 countries, what I'm referring to is the major stock index of that country, and we are controlling for currency risk in these equity curves. So not only natural disasters are important, almost a 10-fold return, but government instability is your #1 predictor. More than 15-fold return since 1999. Now, government instability isn't measuring Libya and Afghanistan because we only took 20 countries that were actually tradable. We excluded countries like Libya and Afghanistan or Uzbekistan, places that you can't easily trade. So this is actually tradable assets here. So government instability does appear to have some interesting value as well. And also, on the emotional level, as I mentioned before, you don't want to buy happy countries. You want to buy the miserable countries. That appears to be your best bet. And fear, also interesting, had this funny spike during the crisis and has only since been recovering. You also want to buy fearful countries, and you want to avoid countries that have very low fear. Now here's what's called a sensitivity analysis. So you might say, as an objection, you might say, well, but does it really scale up to the extremes? Because we know that news and information about government instability tends to be nonlinear. That is, Pakistan has much more severe government instability, and we have much greater fears of that than we do, say, with Japan. If somebody says, well, there's a change of prime minister in Japan again, and it seems like it's an unstable governing coalition, that's a very different meaning than saying in Pakistan that the general may be in an unstable position and the militants might take over. So the question is one of degree of government instability, but in fact we find that even with the more developed countries like Italy or Japan or the United States, when there's been government instability ranked highly, that those actually are good opportunities as well. So what we see here is a sensitivity analysis. The more extreme you go, the greater level of government instability, it is in fact a higher level of a return. So the more instability, now you get talking a 20-fold return over the last 14 years by buying into extreme government instability. And we are running this on our website as well. We've launched this last January, I believe. So it's had some insignificant volatility with the emerging markets generally. As you can see now, it's long India and Indonesia. India has really taken off in the last month. But in Japan, it's been short Japan and Canada most recently. So I snapshotted this yesterday. So interestingly, we are able to pull together this data into a nice smooth equity curve because there's orthogonality in this data, which means that a country that has government instability is not necessarily the same country that has a natural disaster. And a country with a natural disaster isn't necessarily the same country with loose fiscal policy versus tight fiscal policy. And we actually have a variable on fiscal policy and one on monetary policy. So we're tracking a number of different detailed macroeconomic indicators in the news about each country. So when we combine these together, we get a nice smooth equity curve. And now in the out-of-sample period, of course, the forward testing, it's been struggling, but generally it's been positive. So kind of interesting. There do appear values there, even given the emerging market sell-off and a lot of the difficulties. So I'll mention currencies now. So I've talked about U.S. equities and global equities, so let's talk about currencies and then commodities, where we see, again, these three main factors at work. The three main factors are based on behavioral economics, and they are what are people paying attention to, number one, and does that affect the price of this asset? Number two, what are the high impact topics? What topics are very vivid and that everyone in that area can easily recognize that they have impact? And then number three, what are the emotions that are being expressed about that? And does sentiment itself or emotion itself have any predictive value independently? So with currencies, one of the more interesting findings we've had with the Japanese yen, and I should be clear that each asset goes through different cycles of what appears to be significant for it. So there are, for example, we have Boeing stock on our decision trees on our website. And what you can see of Boeing is that the variable urgency has been one of the top predictors of Boeing stock. Now, urgency, the opposite of urgency is delay. So when urgency is low, what it means is you're actually having delays of products at Boeing. And of course, whenever Boeing announces a delay, the market is very discouraged and it sells off. But urgency is actually a good predictor, low urgency or high delay is actually a good predictor that Boeing stock will rally. So after the sell-off, the markets tend to turn and tends to be even stronger for Boeing later. So delays are bad news and they really disappoint investors. There tends to be a big sell-off and then there's a very nice bounce after that. And that's a very consistent pattern over time. So what we're seeing with the Japanese yen is that over the last several years, the price forecast, the consensus price forecast in the news has generally been pretty accurate in predicting where it's going. And what we've done here is taken two moving averages, a 90-day average and a 200-day average. And we're looking at the variable price forecast is future tense references to whether the price is going to rise or fall, for example. So if people are predicting that the yen is likely to rise versus the yen is likely to fall going forward, then we are picking that up as if they say it's likely to rise, that would be in this green area where the short-term pressure is that the news and everyone is saying it's likely to rise. And the blue line is the value of the yen itself. So the yen is the dollar. What we see, though, that's interesting here is that it does, the short-term average captures this sort of acceleration that when the short-term average is dropping faster than the longer term, it means that the consensus is moving in one direction. You see here the consensus was moving for a big sell-off in the yen long before, well, not long before, but certainly well before the big sell-off in the yen began. And it also seemed to time pretty well the bottom of that sell-off. So what are the factors that affect currencies? And in this study, we're looking at the top 10 currencies in the news, going long the top 4, so now the top 2 quintiles, and shorting the bottom 2 quintiles. And again, the goal of this is not to show you a real investment strategy, but to show you where the absolute returns are, which factors are driving prices over time, over any forced period of time. The reason for this is that we know we'll capture there are bubbles over time in different assets, but while I started talking about bubbles, what I'm talking about now are consistent effects that occur every day, everywhere, and that can be arbitraged generally over time. So in currencies, paying attention to a currency or being written about a lot in the media tends to be a good thing. So when you think about the euro, we actually found that there were more specific mentions of the euro than of the US dollar in the last couple of years, because people were, well, they were concerned about the euro breaking apart. And so there was much more chatter about the euro than the dollar. Not much more, but some more. So attention, though, usually when they'd be talking about the euro was about the time that it was at its bottom of its range and it was likely to recover. We also see that violence, so with currencies, you have to think about what are the vivid topics. Well, violence refers to war. And also crime and rates of fatalities in a country that are violent fatalities. So when you notice that there is a higher rate of fatalities in a country or associated with that country's currency, we do see outperformance. Both the CT stands for the country index, so we're using a country index for the currency. We also see the same type of shape for the currency's level of violence itself. So this means war, riots, crime, anything that leads to fatalities. We also see that with a difficult start here, but budget deficits are inversely predictive, just like violence. That is, you want to short the high violence countries, and you want to short the high budget deficit countries and buy those that are low. So currencies are interesting because they're not like commodities, actually, as I'll show you. They're fairly obvious in terms of what's predicting them. Macroeconomically, they've been quite, I wouldn't say obvious, but they've certainly been consistent in the factors that are predictive. Now, on an emotional level, what we found interesting here was that trust. This is references to things like I have confidence in the central bank, I have faith that they'll do the right thing, versus those guys are liars and frauds and they always deceive you. So when you look, this is their trust index, is made up of trusting references versus mistrustful references. What you find here around currencies is that when people trust the currency in explicit mentions, that's the bad thing for the currency. So the contrarianism shows up not in the topic level, which is factual, but actually in the emotions that people are expressing. So if somebody says, I trust that currency, that's generally a bad thing. You want to buy the currencies that are less trusted. If somebody says, I'm uncertain about the policy at that central bank, they don't seem to know what they're doing, I doubt that they'll have any kind of clear roadmap, that's a good thing. And it's actually academic research on central bank policy decisions and target setting, finding that the central banks that have the most opaque targets, meaning the most ambiguity or uncertainty about what they're doing, tend to have higher currency outperformance. So with currencies, you want to buy uncertainty and you want to buy mistrust or low trust. Now, this is a very complicated slide. So this is what we've done with this data, because it's such big data, each asset we've identified, as I said with Boeing, each asset has its own predictors. So we've found that different topics over different times are predictive, and that if you roll that forward, it has appears to have a very valuable predictive capacity. Understanding what people are talking about and then looking going forward, where is that variable now? So we see that with the Japanese yen, this market forecast variable, or price, also called price forecast, same variable, that if you had traded on just the consensus price forecast, again, pro forma, this is not likely or possible that anyone would have done it like this, but it's a Sharpe of 3 and a very high annualized return to have done this. So quite interesting opportunities by understanding what people are talking about in the news and understanding that certain aspects of what they're talking about do drive prices over time. Now, commodities are fun. This is coffee, pre the recent price action. So I guess coffee's up 71% on the year now, which is incredible. What we found with coffee and with many other commodities is that when a bubble forms, there tends to be a real fundamental reason. So we have an index called the surplus versus shortage index. And what happened with coffee was shortages were being reported on coffee. And that created a big rally in the shares. Now, as the rally ensued, the general public, the speculators out there in the news media, started saying, well, coffee's going to keep going, the price will keep going. And they predicted the price would keep going, it would keep going. And then for some reason, perhaps because there really was no more shortage at the top, the fundamental trigger was gone. And what had been driving this price at that point was the collective opinion that it would keep going. So it's a positive feedback loop that what goes up must keep going up, forgetting about the fact that, well, it was going up because there was a shortage, which is the general fundamental trigger for most commodity rallies. Then when the price forecast started to tick downwards, that's when the price really fell apart. So with a few short covering rallies here, but nonetheless, pretty interesting. Recently, what we've seen, the signal we saw last October, about 20% above its bottom, that we were getting a signal that there was likely to be some interesting price action in coffee. So it wasn't perfect timing, but it certainly, given the big move that's happened since then, it certainly did catch something. And then we also have this effect, I should say, in cotton. We've seen it with the cotton bubble, and we've seen it with the natural gas bubble as well. So we see it in commodities generally, that people predict the price will go up, and then it often rolls over. Now, the key thing that you want to know is when the fundamental trigger for the rally has stopped, when there's no longer a shortage, that's when you want to clear out of a bubble. And there's evidence on companies in this particular paper here by Paul Tetlock showing that earnings tend to affect stock returns as a sort of a fundamental trigger. Now, commodities are interesting because they're very different. Each commodity is obviously very different. Now, you could basket them by, say, precious metals or meats, livestock, but ultimately, to have a big sample size to work with in this kind of study, we figured we should just basket them all together. So we internally monitor risks like animal diseases or agricultural diseases and weather damage to crops. But when we combine all the commodities together, obviously weather damage and ag diseases don't affect precious metals. So we have to exclude a lot of our indexes. So what we did here was we took the top 6 of all types of commodities in the news over the last year and then looked at going long the top 2 versus shorting the bottom 2. Now this was interesting in part because we had this sample size of 6 and because we couldn't actually develop trading models off of it, we didn't do any inversions of the equity curves. So I'll explain what that means in a moment. But fundamentally, buzz doesn't matter. Where people are paying attention to commodities doesn't seem to matter that much, at least not on this time scale, on the yearly time scale. It actually does matter on a monthly time scale. There's an interesting equity curve on our monthly data, but for the sake of consistency, I'm only showing you yearly rotational model here. We also internally have monthly and weekly rotational models that shed additional light on how these dynamics play out. So we don't see anything with the buzz. Then we have production volume. Interesting thing about production volume is that when you think about it as in terms of its impact, everybody who's producing or using commodities needs to know what the production volume is. Is it increasing? Is it decreasing? Is it high? Is it low? What you can't really make out here is that if you flip this curve over, it's actually a tenfold return over the last 14 years, arbitraging commodities by the production volume level. That is, you want to short the commodities with the highest production volume and buy those with the lowest production volume. Sort of a supply-demand curve type trade. Pretty obvious, but pretty fascinating that it actually worked over time, that people did not adjust prices quickly enough to take advantage of news about production volume. Now, here's an index called, again, market forecast or price forecast. It also has some apparent value, though it's definitely noisy. And the value appears to be in specific periods of time, like, well, volatile periods of time. Market forecast, so what this generally indicates, a general relationship here, is that when people are predicting that commodity prices will rise, they tend to be wrong. Commodities actually fall. So beware of commodity speculators or salesmen who come out saying we see oil price hitting $300 a barrel. When you start seeing that all over the media, well, that's a pretty good indicator that oil's about to have a setback. The other thing we see that's interesting, we call this an emotion. It's really just uncertainty. We didn't track many emotions relative to commodities in our first data version. We're rectifying that in our second one. So uncertainty, you could say, well, that's not an emotion, but we'll just call it one for today. So the thing with uncertainty, this is actually a really nice equity curve when you put it out over time. And what it indicates is that you want to avoid uncertain commodities, that is where there's concerns about production or droughts or whatever it is. You want to find those where there's more clarity in terms of forecasts and the public's understanding of them. And this one argues for that fluency effect, that clarity and ease of recall tends to be positively predictive in this case. This is opposite of what we saw with currencies, where uncertainty tended to be, well, actually no, it's the same, I'm sorry, but without the negative sign. Uncertainty is positively predictive of currencies, it's negatively predictive of commodities. There we go. So it is the opposite of currencies. A lot to keep track of. So I mentioned Boeing and finding the price drivers, like the yen, that the price forecast is the primary predictor of the yen itself. And delays are the predictor of Boeing. How do we do that? Well, we actually use machine learning in a technology called classification trees. So what we're doing is dividing up our sample set and trying to find what are the concepts, sentiment from the news or news about the price rising versus falling, that are the most predictive of different samples in this group. So we've got a few examples of that on our website as well, where you can go through different assets and see what's been driving them. Sometimes it doesn't make sense, sometimes it does. That's the nature of big data. So forward testing on economic activity, starting last May, we started publishing in real time a predictor of the PMI. The PMI comes out in a flash number at the third week of the month, and then in the formal number the first day of the new month, typically, depending on the country. What we did was the day before the flash PMI, we issued our own forecast that had been built on a model that was predicting the PMI. This is done by Alexander Fafula, who's our chief data scientist. And using that model, we found from May to the recent period, we've had 70% accuracy in predicting the direction of the PMI, the flash PMI, and actually 79% predicting the flash or the actual PMI at the end of the month, which means that the actual PMI is being revised toward in our direction from the flash number. The flash tends to be incomplete. So we thought that was pretty interesting that, in fact, by monitoring factors in the news flow, like inflation or economic growth, that these are generally predictive of economic activity itself, or at least of the economic numbers that are coming out. Hard to say that a survey by Market called the PMI is any better than what is already coming through in the news. So I would say in about, I don't know, 5 to 10 years, this type of indicator will actually replace the PMI as being more influential, because it's a real-time social media news monitor of economic activity. And when I say that, what we find is that the high-impact concepts here on economic activity are concepts like inflation. So when people are talking about inflation in social media news, it tends to be a negative influence on future economic numbers. When they're talking about economic uncertainty, it also is a negative influence on the future numbers. Conversely, when they're optimistic, positive sentiment, talking about economic growth, those predict that economic growth will in fact rise. And by the way, economic growth includes concepts such as business expansion, business hiring, etc. So it's a very broad term for us. So in summary, don't trade on any of this. This is our disclaimer. So be careful in your investing and know what you're doing before you do it. Use this to augment your own decision-making process, of course. And we have a version of our data coming out very soon, within a week or two. What this data is the 7,000 global equities. It includes new social media content. We have improved source filtering. None of this matters if you're not into the big data side of things, but it's going to be very exciting for us knowing this data and working with it almost every day. So I would love to open it up for some questions. So in summary, we've got availability, vividness, and emotion that distort investors' probability assessments. And we see these effects in crowd perceptions of assets and in pricing itself. So I'd love if you could check out our website, marketpsych.com. We have a number of plans there, especially the professional plan, which allows you to chart various sentiments. If you really want to get into the details of this, contact us personally, and we'll show you what's called our researcher's plan, where we show you the different investment models and how they work. So please do reach out to us with any questions. And we are speaking, as was pointed out at the beginning, at the Behavioral Models and Sentiment Conference applied to finance, the June 18th and 19th in London. So we'd love to see you there as well. We were there last year. It was a lot of fun. It's great. I think the best conference in this area. So, yep, love to open it up to questions, and thank you for your time. Hope you found this useful.
Thank you, Richard. That was excellent. I'm sorry, folks, we're just a few minutes over, but there's such great content there. We didn't want to cut Richard short at all. I think there are a couple of questions now coming in. Can you see the questions there, Richard?
Oh, there they are. Okay, let's see here. How do you buy anger? Great question. So I guess I didn't explain my process very well at the beginning. So fundamentally, we're doing text analytics. So we're analyzing language about how people are talking about a company or an asset. So if somebody says, I really hate Jamie Dimon, he's a terrible CEO at JP Morgan, then we'll score that as a 1 or a 2 for anger. I guess 2 because they hate him, because there's a lot of anger. So we would score that as a 2 score for anger for JP Morgan. So when you get thousands of comments like that, like I'm really, I'm enraged at how Bank of America is charging me these high fees, or I'm really frustrated with the customer service of American Airlines. That's anger. And so the more that you have anger expressed towards a company with these scoring systems, then you can rank that anger, and then you buy the companies where you have the most anger in the last year. Carnival Cruise Lines being a great example with their overflowing toilets. So I hope that helps explain that. And how we do it is we have metrics to understand what people are angry about. How you would do it is notice in the news. If you don't have this data, then you look in the news and you say, what are people angry about? Where are people enraged or up in arms about something? That's actually what you want to be buying, generally speaking, in a big portfolio. Okay, other questions? Oh, get slides. Machine learning, inconclusive. Machine learning is challenging. So to use machine learning on this data, it is important to, we found that the goal when you work with this type of data is you've got to find the right statistical algorithms. So machine learning, if you use, say, random forest decision trees, you do get positive out-of-sample results. Cross-sectional validation or whatever, however you want to do it, you get positive out-of-sample results. They're not astronomical, but they are interesting. So I wouldn't say they're inconclusive. There's definitely value. However, that's random forest decision trees. So we find the best results on other types like association rules, which prevent overfitting that decision trees tend to like to do. So when you have, say, a very two-node tree or an association rule, that's where you get the better results because there's less overfitting. So how do you do analysis considering correlated between assets within the same segment? Well, that's why we do the ranking system. That's a good point. So that's why if we're looking at, so say there's the Arab Spring. Now, that's not a good example because it doesn't affect us, but like the Eurozone crisis. So if we're looking at economic activity across Europe, and obviously it's correlated because of the trade, we have to be careful to rank the countries by the level of economic distress. So when we do that, we Spain and Italy at the top, of course Greece at the very top. And so that allows us to then create these basket analyses or binning studies, quantile studies. So it's a ranking process because you're right, at times everybody's in crisis. And so the question is who's in the worst crisis and who's in the least crisis. Other questions?
I think we've come to the end of the question. So thank you, Richard. That was excellent. Just to remind everybody that we will be making the recording available. We'll send an email with a link out to everybody who's attended today, and we'll obviously publish a link as well so other people can hear a recording of the webinar. Thank you again, and we hope we'll see you at the conference on the 18th and 19th of June. Thank you. Goodbye.
Thank you. Bye-bye.